Thank you, everyone. My name's Kevin Webster. I'm very happy to be here. Thank you, KX, for inviting me. Thanks, Connor, in particular. And so I'm a professor at Imperial College London and at Columbia University. And I'll be talking about how KDB empowers researchers to do good research on price impact and price impact models. So let me start with some definitions, just because these terms, sometimes people have different definitions for different things. So what will I call price impact? I'll actually quote Jean-Philippe Bouchot, physicist and co-founder of Capital Fund Management, a quant hedge fund in Paris, I think 10 billion aside. So he also wrote a book on the topic, and he defines price impact as the reaction to order flow imbalance. And the key word here that I highlighted is reaction. When we talk about price impact, we talk about a causal model. If I didn't trade, that return would not have happened. So you really have to think about this parallel universe where I choose not to trade, and therefore that return doesn't happen. We'll talk about the opposite scenario when we talk about alpha signals. But so with this definition of price impact, you can now measure this. You can measure this either by just measuring correlations between trades and prices with some caveats. There are some biases that can happen when you do that. Or you can submit random trades and see how they react. That removes most of these biases. These are called live trading experiments, or randomized trading experiments, or A/B tests. So CFM did some of that to answer a very specific question in a past paper of theirs, which is trading in US equities anonymous? At least on the short end of the spectrum. Long-term, people can eventually find a signature, but is it anonymous enough? Does the market reaction show whether it's me trading, CFM trading, or just some random trade that has no informational content whatsoever? And so they came up with this curve based on their own proprietary trading data, the public trading tape, and then there's a third curve, which I don't show here, but it's in their paper, which is just literally randomly submitted trades, which obviously cost money, but for the purposes of scientific evaluation is an important benchmark to have. And so there is some distinction, especially on the very short end, lag one tick. You can see some gap, but for the most part, on that 5 to 100 tick range, it's actually quite hard to distinguish at least CFM trades from market trades. I'm not going to go into more details there, but the main point here is that people, both in academia and industry, run regressions to estimate this effect. This is not just a like theoretical economics type concept. This is something that you can measure. Price impact as a reaction to trades. Now, this is the track on alpha research. So I really, really want to emphasize that distinction and the commonality between alpha research and price impact. So I defined, first, everybody cares about alpha research, and to some degree also price impact. But and quants and traders really care about these things. So let me distinguish them as clearly as possible. In my definitions, alpha signals correspond to returns that would have happened regardless of my trading. So in this parallel universe where I choose not to trade, the return would still happen. If that's the case, then I'm predicting alpha. If, on the contrary, in this parallel universe where I don't trade, the return would not happen, then that's price impact. Again, very simple causal distinction. It matters because alpha signals are trading opportunities. If I choose not to trade, I miss out on this amazing return. I lost money compared to the scenario where I do trade. In the other case, if it's price impact, that return isn't really a profit. Actually, it ends up being a cost. So instead of being a trading opportunity, a return that's caused by price impact is a cost. Okay, so that's all very formal and high level. So let me quote my ex-boss, Daniel Nairn, who's now at ADIA, which is a large fund in the UAE. And so he answers the question, why distinguish between price impact and alpha? Again, they have different definitions, but why do we care about the difference? I'll quote, if we find that most of the cost is due to price drift, alpha, the best option would be to accelerate the trading and pay more impact to capture more attractive prices. Conversely, if the cost is mostly driven by impact, then it would behoove us to slow down our trading to minimize the impact. So the same return prediction, whether it's price impact or alpha, lead to opposite trading decisions. And again, most traders here will find this completely obvious and trivial, and I apologize, but I really want to make all of this clear before we go into more details. So based on the definitions I gave in this quote, it's really crucial to trading algorithms and portfolio managers to distinguish and to be able to measure alpha and impact. Okay, so that leads to the applications of price impact models. Once you distinguish between alpha and impact, and once you understand that they lead to different actions, that opens up all kinds of applications. Here is a non-exhaustive list of applications and papers that cover these applications. Again, non-exhaustive. I apologize if you have a great paper that's not on there. There's plenty more. I just gave representative examples. So optimal execution is considered the canonical application of price impact models. The seminal work there is the one by Almgren and Chris. Almgren is also the co-founder of Quantitative Brokers. So it's a great paper. You should read it, as well as many other papers by Almgren. Transaction cost analysis is kind of the flip side of optimal execution. In optimal execution, you ask the question, okay, given my alpha signal, given my price impact, what's the best way to trade this signal? Transaction cost is ex post. After I've traded, did I do the right thing? Did I do, for example, best execution for my client? So the math ends up being quite similar, but that ex post perspective makes it more of a statistical exercise rather than a optimization exercise. So here I like to quote two senior researchers from Alliance and Bernstein who use their proprietary data in their large fund to do some analysis there on how to use price impact models for transaction loss analysis. I also like to quote Lehal, who is also at ADIA. He has a similar paper for fixed income, which I think is important to acknowledge that this works across assets. Statistical arbitrage is more on the portfolio sizing effects of transaction costs. The seminal work there is Galliano and Pedersen. Pedersen is now at AQR. But I also like to quote the Mann Institute has a recent paper that's actually quite amazing on that front. Backtests. Quants and traders run a lot of backtests. And so price impact models play a big role in simulating what would the world have been had I traded differently, had I put on a different trade, had I sized my portfolio differently. So there my favorite reference is Wellbrook, who has a paper on optimal execution, how to backtest strategy A versus strategy B, considering price impact. Last application that I like to highlight to kind of move away from just purely trading, though again, this is a conference where most people are mostly focused on trading, liquidity risk management. So specifically, how do I simulate and quantify liquidity stress tests? So if I have a fire sale, if I need to liquidate a position because risk is accumulating, how do I simulate the trading of that decision, the trading costs of that liquidation? And the answer is based on these papers by Bouchot and by Gonzali. Gonzali works at a large European fund and is also the author of the Handbook of Risk Management. The answer is you can't just use your out-of-the-box TCA model because it has embedded in it assumptions around standard market conditions. With the price impact model, you can update that to include higher correlations between agents, which is really what you want when you talk about fire sales and liquidity risk. A liquidity risk model is really just a standard TCA model where you ramp up the correlation with the rest of the market because everybody else is trying to do the same thing as you. At least, again, this is how these two papers view that particular topic. Now, how does KDB come into the picture? I've motivated what is price impact, what is its relationship to alpha research, and all these applications that come from it. And again, this was a non-exhaustive list. What you need to understand is price impact models are, and I hope this is not humble brag, but are considered some of the more mathematically difficult models, both to run and to solve. I see a lot of heads nodding. It's just a thing. And part of that difficulty is, and these three boxes, it requires high fidelity trading data. Even small imprecisions in your data cascade very quickly. These are path-dependent models from a math perspective. Again, mistakes propagate extremely fast, and you need, again, high fidelity data from a research perspective, low latency data from a production perspective. These are models that need to run in production. So I think I'm preaching to the audience here, but KDB is pretty good at these things. You also need to be able to backtest all these things, or test or do statistical analysis on tick data, again, because you don't want to do too many approximations. Errors tend to propagate quickly. So there, high velocity, scalability are keywords. These two are kind of, though, in some sense, not specific to price impact. I could say both of these things about alpha research. I think what distinguishes alpha research and price impact, though there's plenty of synergies between the two, is the path dependence of price impact. In a way, the endogeneity of price impact, in a way that alpha research tends to assume everything is exogenous. And because of that, there's just some key operations which boil down in KDB speak to more as-of join operators and more accumulator-style operators that just aren't quite as widely used in alpha research. You can use them, but I think all of us have seen alpha models that use none of that fancy machinery. You can opt out of it, essentially, is what I'm saying. You can use Python if you want. You can't for price impact. There is no opting out of that. So I'll give two examples from my own, in this case, academic research. So one is estimating price impact from Lobster data. If you wonder what is Lobster data, it has nothing to do with out there. It's just academic version of Nasdaq edge data. So Nasdaq edge data, you need to reconstruct the order book. So some academics banded together to do that exercise once, and that's called Lobster data. So all of this is, I think, reasonably standard and actually, from an industry perspective, probably reasonably small scale work. But again, being able to do that in an academic setting very fast and very iteratively is quite nice. So I'm using Nasdaq edge data, again, this Lobster version of it. I look only at public trading tape. I have no proprietary meta order information. I look at the S&P 500 over 1 year, every single tick, and the usual bottlenecks that could appear when dealing with that kind of data appear. So loading tick data, computing impact, again, this path-dependent formula on that. And more importantly, because I'm trying to do as scientific research as possible, I'm not going to run just one model. I'm going to run tens of thousands of models. I want different slices by time of day, different slices by stock sectors, sensitivity analysis around parameters. I'm going to have to run through the data many, many times. So I need something that performs. So here are four kind of building blocks to my models. Those are the ones that expand to the 10,000, but these are the four basic ones. The exact formulas don't really matter. I just put the names of the authors that I pull them from. Again, these are just models from papers. The key point I want to showcase is, if I had grid data, some of these could just be exponential moving averages. It could be derived from exponential moving averages. But because I have tick data, and these are path-dependent formulas, I need accumulators, essentially. I need something that looks recursive in any other language. I also need as-of joins to then, I want to compute them on all the events that matter, and then as-of join them on the events that I want to measure it on. I don't want to run through all the non-mattering events, because again, it's a path-dependent formula. Running through all the events is going to be overly time-consuming. But yeah, so I have four models, four formulas. I don't know how much time I have. The original one's the OW model, and then I have two nonlinear models. If you've heard of the square root law, the two bottom ones have the square root law. And yeah, if you have questions, feel free. I'm very keen to talk about models, but also this is not the main goal of the talk. Here are just some code snippets about like how few lines of code this really is in KDB, and why I keep talking about accumulators and as-of joins. Top line is, why do I need accumulators to do this recurrence equation, or this induction equation, recursive equation? There you go. On tick data, again, if it were regular data, I may, for some of the models, I could just use an EMA, but because it's tick data, and for some of the models, it's not just an EMA, I need accumulators, so it's more general, more performant solution. I need to rejoin it with some market data, so that's obviously going to be an as-of join, that's kind of standard. But the last thing I mentioned is the whole sparse versus dense. If you use the full public trading tape, it's not going to be sparse, it's going to be dense. But if you have your own data, or if you look at a subsection of trades for whatever reason, small trades, large trades, that's going to be sparse. You don't want to run your expensive, nonlinear, path-dependent functional on the dense data. You want to run on the sparse data, as-of join against the dense data, and then because you have the as of joined property that there was no events between your timestamp and the previous event, you can just use a decay formula to figure out, okay, no event happened. There's just, let's say, an exponential decay between my last event and my as of join time. I'm going through this very fast. The key point is the theme of the day. Having native time operations happens to be key for price impact models because even more so than any other trading application, you have this key dependency on time in this very path-dependent way. Okay, here are some high-level performance metrics. So this is not a horse race. The Boucher model does perform quite a fair bit better, but again, I can cut the data, and some subsections of data will be worse. This is just to highlight the kind of regression result you can have. And again, more to highlight KDB's power here. This previous one is the very high-level stats across all of the sensitivities, but you really want to check, okay, what happens if I move the prediction horizon from predicting the next minute to the next hour to the next 2 hours? What if does the model behave differently at different times of the day? Does it behave differently when there's large imbalances in the market versus when the market is pretty balanced between buys and sells? You might want to run it monthly or even daily. All these things are just sensitivity analyses that reuse the same functions as before, but you need to scale them across a lot of nodes. And again, that's something that that requires scalability of some sort. And maybe something that's not emphasized enough, scalability and reproducibility. So again, having lightweight terse code may have disadvantages from other perspectives, but from a reproducibility perspective is quite nice. And reproducibility is kind of important for scientific research. Okay, second example. Randomized trading experiments. So there'll be only 2 slides for that one. The first one is going to be, why do I care about that, and motivation. And the second one is going to be what kind of research you can do in that context, at least in simulation. So what problem am I trying to solve? I'm putting myself in the shoes of a broker, and a core problem of a broker doing, for example, TCA or best execution is estimating the price impact of their client order flow. Now here's a key problem. Clients don't submit random trades. They actually expect to make a profit on their trades. Otherwise, they wouldn't be submitting them. What that means in our vocabulary is that clients have alpha. And when you measure their arrival slippage, this won't come as a surprise to anybody, but you measure both the alpha and their price impact. How do you deal with that? So I'll quote Soteropoulos, who was a Deutsche Bank at the time, on this topic. So first, this alpha story. Since skilled traders correctly predict short-run future returns, the costs of their trades appear high. As a result, measured execution costs may not be an unbiased estimate of the true cost of trading. So this is a different way to rephrase this whole alpha versus impact entangling problem. And what I really want to do is disentangle the two, which from a causal perspective really means separating correlation from causation. So how do you do that? There's other ways to do it, but one way, again by Soteropoulos, but also CFM, is to use randomized trading experiments, to literally submit random trades or randomize some aspect of your trading, whether it's the speed, the size, something needs to be randomized to decouple the alpha and the impact so that you can actually measure causation, which is what you need to measure price impact. So I'll quote Soteropoulos again. It is important to acknowledge that when we run these analyses, it's done only for a subset of orders that are affected by a controlled A/B experiment with routine changes so you can really quantify the impact. I've highlighted controlled A/B experiment as a synonym for randomized trading experiments, and the keyword control here is very important. These experiments need to be as fair as possible, which involves really flipping a coin. So what did my co-author Nick Westre and I do to quantify that? And we took a slightly different angle. Instead of asking the question, can we measure price impact for a client, given that we didn't have client data, we asked a more statistical question, which is, let's assume we do this, and we're going to do this in a simulated environment. What kind of confidence interval can you expect from this? And this is an important question because these are expensive experiments. You're literally flipping a coin to trade to decide how much impact does it have. You're not going to do that a lot. You won't have many chances to do that. Again, I can either quote Deutsche Bank or CFM for like how many trades they did, but the point is not that many. And so you're not going to be able to test empirically how good your experiment is. And so we said, well, if you don't have enough empirical data to figure out how good one experiment design is versus another experiment design, or what kind of confidence interval you can expect from that kind of experiment, can we at least do that in simulation? So using a ground truth model, we simulate a certain price impact. We use the historical trading tape. We use some alpha signals. In this case, synthetic alpha signals. And we simulate, in this case, a dozen types of experiment designs, so a dozen choice of like how much randomness do we inject in the system, how many trades do we do before we conclude, all these kinds of decision variables that go into an experiment. We simulate hundreds of experiments for each design. Why hundreds? So that we can compute a confidence interval. So we don't just have like the outcome of one experiment, but we also have a bootstrap confidence interval. And then we assign for each of these 100 copies of an experiment, we simulate billions of orders to actually simulate the actual trading. So once we have that, we have the alpha signals, we have the price impact. We know the ground truth because it's in a simulation environment, so we know the true alpha, we know the true impact, and we ask the question, a broker that has that data with live experiments, without live experiments, how quickly do they converge to the correct answer, and what kind of confidence interval can you get? And we happen to find that a particular machine learning model called causal regularization works the best. But again, the conclusion is broader than just, hey, use this machine learning algorithm. The conclusion is more, do experiment design. Figure out what kind, if you're going to do live trading experiments, please figure out what kind of experiment design you want, because there is a broad range of outcomes in terms of cost and in terms of confidence interval. Now back to KDB. Obviously, this wouldn't have been possible at this scale with this number of, going through this much historical data, running these many backtests without high performance, scalable compute. I appreciate I'm going reasonably fast over how, but I also think like anybody who's used KDB kind of knows the difference. And so the details don't matter, more the application. I'll conclude with a complete tangent here, which is when I started, so I started using KDB at Deutsche Bank essentially 10 years ago. And I learned mostly from this little booklet called Q for Modals, which I'm sure most of us have. And it's a great book. But I also want to highlight that there's now a couple of books more aimed at quant researchers, including particular Nick's book, who Nick is going to present tomorrow. But yeah, there's a broad range. There's 2 dedicated books, and then I just have an appendix. So from a pure textbook perspective, please use the other 2 books. They're much more complete than mine. But if you're interested in price impact, have a look at mine. And that was it. I appreciate I speak very fast, so I apologize. If you have any questions, I'm more than happy to field them. That was it on my side.